Welcome to the quarterly Global Listed Infrastructure video. Today I'm speaking with Gerald Stack, Head of Investments and Portfolio Manager for Infrastructure Strategies. Thanks, Gerald.
Thanks, Mark.
Gerald, perhaps if we can start by asking, how do you believe the portfolio has held up throughout 2017?
So calendar 17, or indeed the 12 months to November, most recent data, is showing that infrastructure generally has done very well, particularly our defined universe has done very well. And similarly, the strategy has performed well and is currently trending ahead of the performance of the sector over that time. If I think about our universe in two parts, infrastructure and utilities, it's the infrastructure assets that have done particularly well. And within that, it's patronage assets that have done particularly well. So toll roads, airports, rail have all done exceptionally well. Communications infrastructure has also done well. And why underlying drivers have performed strongly through that time. We've seen strong traffic growth in toll roads around the world. We've seen very strong passenger growth in airports. We continue to see incredibly strong growth in data through communication networks, and rail has also done very well. So it's in particular the infrastructure component of our portfolio that's done well. Utilities have performed to thesis, but not as strong as the infrastructure assets. And then if you think about our defined universe, there are some certain things that we don't invest in particular oil and gas related assets, and they've had more of a struggle this year. So the benefit of our discipline definition has meant that we've avoided some of those assets which would have had been a tough gig in the last 12 months.
Right. What are your thoughts on the US impending tax changes and any implications for your portfolio?
So there are three types of assets, three sectors that we can invest in the US. Regulated utilities, rail, and mobile phone tower companies. If we think about regulated utilities at the end of the day, the construct that they have with their communities is the regulator allows them to earn a fair return. And a fair return today is around about a 10% return on equity. And they're allowed to price their product so that they earn that fair return. Any changes to tax we would expect to be a pass-through. So they're largely immune from changes in tax. They don't benefit from the change in tax, and nor would they find themselves off in a worse situation if tax rates indeed increased. So utilities, as I say, essentially a pass-through. The mobile phone tower companies, similarly, they're in tax pass-through entities. They're REITs, they're trust structures. So again, the tax changes should not impact those companies to a great degree. Rail will be a beneficiary. Lower tax rates for rail, they're in corporate structures, will lead to improved result for shareholders, and certainly over the course of the year we would argue that the share prices have already taken some of that into account, that they've baked some of that benefit in. So three sectors, slightly different situations, but of not massive consequence for us just at the moment.
Thinking regionally, UK has had a tough year, particularly utilities. What's been driving that?
So there's a couple of issues, and both are political or sovereign in nature. The first is Brexit, and the hangover from Brexit, the uncertainty that Brexit leads to, has led to some difficult situations for some of the utilities that we invest in. And more recently, the political instability in Britain and the rise of the Labor Party in the UK has meant that the Labor Party's manifesto has been uppermost in people's minds, and the Labor Party manifesto includes a declaration that they'll seek to nationalise the utilities, both water and energy. There are two regulated water utilities that we invest in, one energy regulated utility that we invest in the UK, and each have suffered in some degree around speculation coming out of that. So the combination of two political sovereign issues, Brexit and potential nationalisation of these assets, has led to some share price pressures. The underlying operating performance of these assets has been very much to thesis. They continue to perform well, and we continue to watch them closely. We'll see what happens in the years ahead.
And finally, Gerald, thinking about 2018, what are the key issues on your mind that investors should be aware about?
So ultimately with infrastructure, as we said, there are always two key risks to be concerned about. One is real interest rates, and the second is sovereign risk or politics. On real interest rates, we would expect real interest rates to rise. We do not believe that current pricing of infrastructure assets is based on the prevailing rate of real interest rates. In other words, the prevailing real interest rate, 10-year US government rate in the US is approximately 0.5%. It's our belief that that's not being priced into infrastructure values today, that the rate that investors are pricing in is a good deal higher than that, that the investment market generally expects interest rate increases, and therefore that underlying values are acceptable on the basis of those higher rates. That's not to say that when interest rates rise that we won't see some sticker shock. Ultimately, short-term share price is determined by the marginal buyer and the marginal seller, and if as a result of interest rate rises, the marginal buyers are not there in the market, then we'll see some share price reaction. So we would expect some volatility around infrastructure and utilities assets over the next 2 to 3 years, but we do not believe that valuation is fundamentally challenged at this time. So that's a key issue, interest rates, it's a key risk for us. The second risk, second key issue, as I said, is sovereign risk and politics. We've seen around the world in a number of jurisdictions that political constructs have come under pressure. We've seen this in Spain with the potential secession of Catalonia. We've seen it in the UK, as we've already touched on. We've seen it in a range of different jurisdictions. Ultimately, the nature of infrastructure is you build a big piece of capital equipment and you rely upon, as the owner of that piece of capital equipment, a long series of cash flows into the future. And if, to the extent that changes in the tax or political construct mean that those cash flows come under threat, then that ultimately goes to capital value. So we're certainly seeing the rise of some of those risks in recent times. If I look back over the last decade, it's been a remarkably stable period in terms of sovereign and political risks, notwithstanding the fact that the world has gone through a pretty deep recession in that time. And that gives us some hope and confidence for the future, but that's not to say that there aren't risks out there today.
Thanks, Stacky.
Thank you.